Welcome to the debate.
Today, we are diving into the recently released operating results for Costco Wholesale Corporation. This is for the full fiscal year ended August 31, 2025. And, the numbers are, undeniably spectacular. You're looking at $8.099 billion in net income and total net sales pushing nearly $270 billion.
Just remarkable strength, really, year after year. So the question we're tackling today, based on these really robust results, it centers on sustainability. What is the true sort of primary engine powering all this success? Is it the unparalleled stability and loyalty that comes from their unique membership model?
Or is it the indispensable, the relentless sophistication of its operational execution? And, let's not forget, the massive capital investment they keep pouring in.
Right. And I'm going to contend that the membership model, that's the core engine. It's the strategic asset driving everything else. That predictable, high-margin fee revenue, that's their secret weapon. It's what allows them to dominate retail the way they do.
See, I come at it from a different way. I'm going to argue the membership fee is, it's merely a beneficiary. It's a reward, if you like, that they get from the rigorous operational control and the huge strategic capital investment. Without that aggressive, industry-leading pricing and the value delivered by, frankly, impeccable execution, that membership model just collapses. Operational rigor is the foundation. The fee? Well, that's just the roof.
Okay, let's look at the evidence for stability and loyalty then. For me, the proof of the model's dominance is right there in the membership income growth. It significantly outpaced sales growth. For the fiscal year, membership fees hit $5.323 billion. Now, that income grew 14.0% year over year, or still a very strong 13.6% if you adjust for currency fluctuations. Now, compare that to net sales growth of 8.1%. That difference, that disparity, it shows where the real leverage lies.
I think that perspective, it fundamentally misinterprets the chain of causality here. That $5.3 billion, yes, it's high margin, it's sticky revenue, I grant you that, but it only exists because the operations justify paying that annual fee. My operational thesis is, I think, far more compelling when we actually look at the efficiency gains. The company achieved some pretty significant margin improvements in Q4 2025. Selling general and administrative expenses, SG&A, basically the running costs for the whole global business, they were down 17 basis points as a percentage of sales. And crucially, even when you strip out the impact of volatile gasoline sales, SG&A was still down 9 basis points compared to the prior year. That's not insignificant.
Okay, that operational efficiency, those 9 basis points, is admirable. Sure, but how does the membership model confirm its dominance?
It's the stability factor. The number of paid memberships grew 6.3% to 81.0 million. And just look at the worldwide renewal rate. It stays almost untouched by economic bumps, sitting at 89.8%. And in the really mature US and Canada market, that renewal rate is even higher, 92.3%. This sticky, predictable revenue stream is basically insulated from the margin pressures other retailers face. No general retailer can claim that kind of captive, committed traffic.
But why is that renewal rate so high? You have to ask that. It's not just some passive loyalty, it is the result of the operations delivering value. The company reinvests its massive operating cash flow, and they do it aggressively. Just look at the balance sheet. They spent, $5.498 billion in additions to property and equipment, that's CapEx, just for the fiscal year. That scale of reinvestment is what ensures continued value for members. And the 9 new warehouses opened in Q4 alone, 5 of them right here in the critical high-competition U.S. market. While that proves that growth is fueled by strategic deployment of cash, not just by collecting membership fees. The membership fee is effectively a return on the investment, it is not the investment itself.
I see why you lean so heavily on that CapEx figure, yeah? But let me offer a slightly different perspective on that operational rigor you mentioned. The SG&A efficiency and the margin improvements you cite, even that impressive 9 BPS reduction, it simply means the operations are efficient enough to hold up the low price guarantee that the membership structure absolutely demands. That operational movement is just the tactical execution needed to reinforce the core strategy. Consider the 29 basis points improvement in core-on-core sales margin for the quarter. Now, this is a very specific, high-level metric Costco uses internally, generally stripping out gas and FX effects. That efficiency gain, well, it isn't just kept as profit. It's strategically pushed right back into lowering prices. You know, the famous $1.50 hot dog or the perpetually low price of the rotisserie chicken. The operational improvement is the mechanism they use to safeguard the primary asset, the member base. They give them irresistible value. It's a tool for retention, fundamentally.
I think you might be confusing cause and effect there. I absolutely agree that operational discipline has to be maintained to keep the price promise. That's table stakes. But achieving a 29 BPS core-on-core sales improvement, that's 29 0.01% on hundreds of billions of dollars in sales. That's not just maintenance. That is strategic profitability. It demonstrates industry-leading supply chain and inventory control. That rigor, that is what generated $3.341 billion in operating income for the quarter alone. Without this relentless push for efficiency, controlling everything from inbound logistics to how they use labor, members would leave the club regardless of their annual fee. The fee might lock them in temporarily, sure, but it's the value created by that operational prowess that keeps them coming back year after year.
Okay.
And, let's pivot slightly to how that operational rigor enables growth in, new channels. Look at the e-commerce performance-adjusted comparable sales jumped an impressive 13.5% in Q4. You can't just attribute that solely to a loyal member clicking a button at home. That kind of growth requires tangible, complex, and frankly, expensive investments in fulfillment infrastructure. And that is exactly where that $5.498 billion CapEx figure comes into play. It funds the necessary logistics, sure, but also those crucial digital enhancements. Things like data augmentation to make search better, the online waiting room system for high-demand items, developing passwordless access for the mobile app. All these things make the digital channel viable and help it grow in those high-value categories.
Okay, I'm going to challenge the premise there that CapEx and e-commerce infrastructure is the primary driver. I'd argue the e-commerce growth is high precisely because it caters to the existing captive membership base, especially for those high-ticket categories like gold and jewelry, tires, major appliances. The members are already committed. They've paid their annual fee. They're simply choosing a different fulfillment method for items they were probably going to buy anyway. And furthermore, when we actually analyze that, nearly $5.5 billion in CapEx, the vast majority is still focused on building physical infrastructure. 9 new warehouses opened in Q4. They're planning for 20 in FY2026. This expansion strategy, it's foundational? Yes, absolutely. But it's a pretty traditional retail growth model. And that model only works with such, unprecedented predictability because of the built-in customer base that's guaranteed by those 81 million paid memberships. That's what ensures the strong comparable traffic growth, which was recorded at 3.7% in Q4, whether the sale ultimately happens digitally or physically.
But you can't separate the member from the store, or the website for that matter. That investment creates the physical and digital opportunity for loyalty to actually manifest itself. You simply cannot generate membership fees in a brand new market like Malmö, Sweden, or even a crucial new domestic spot like Allen, Texas, without first deploying serious capital to build the infrastructure, train the workforce, and get the supply chain under control to replicate that core value proposition.
Well, this brings us nicely to international results, which I believe really underscore the power of the model over just pure operational scale. Adjusted comparable sales in other international were up 7.2%. That notably outperformed the U.S. adjusted comparable sales, which were at 6.0%. This suggests to me that the core model, that annual membership commitment, it translates globally with pretty high efficiency. It pulls in new members who generate that lovely high-margin recurring revenue stream, maybe even before the operational maturity of the local warehouses is, fully established. The model itself provides the necessary flywheel effect.
That's an interesting point, though. I would frame it quite differently. I see that international performance as a testament to the operational discipline needed to replicate success in what are often very complex new markets. Expansion into Sweden or other new territories, it's incredibly costly. It's highly dependent on an impeccable operational setup and significant upfront CapEx.
So the sustained growth in international traffic is, in my view, directly dependent on strategically deploying that $5.498 billion.
Okay, but the funding.
Well, let's look at the funding mechanism. We saw net cash provided by operating activities increase to $13.335 billion for the fiscal year. Now, that operating cash flow, which is generated by sales execution, by selling goods efficiently, not just membership fees, that is what funds the strategic investment. The $5.3 billion in membership fees is significant, yes, but it's nowhere near enough to fund the $5.5 billion in CapEx and sustain the entire global operation on its own. That massive operating cash flow, the $13.3 billion, has to be recycled directly into new infrastructure and sophisticated supply chain control to keep expanding successfully and to ensure that the value proposition is consistent across all borders. That $13.3 billion generated by efficient operations, that's the true strategic resource here.
Okay, look, ultimately my position remains pretty firm. The sustained high worldwide renewal rate, hovering near 90%, at 89.8%, and that solid 14.0% growth in membership income, they confirm that the fundamental driver remains the stability that comes from that massive loyal membership base. The value proposition, the low price, that's the mechanism, sure, but the membership fee is the commitment, the core asset. Operational excellence and strategic CapEx are absolutely critical. Yes, they're supportive tools, but their main purpose is really to protect and feed this core asset of membership loyalty.
I'm sorry, but I just don't buy that the operational rigor is merely a support mechanism. I see it as the engine, the thing driving the value proposition that actually justifies the fee in the first place. The membership revenue only works, only exists if the company executes, frankly, flawlessly on pricing and efficiency. The evidence clearly shows a relentless focus on reducing costs. You see it in the 9 basis points lower SG&A and that massive commitment to future infrastructure through the $5.498 billion in CapEx. These are the active, strategic decisions that are driving the stellar overall performance, including that impressive 14.0% growth in diluted EPS for the fiscal year, excluding last year's tax benefit, of course. Without that intense financial and operational discipline, the members simply would not renew, full stop.
A robust debate indeed on what is undeniably a truly exceptional set of results for Costco in fiscal year 2025.
Yeah, absolutely. The numbers clearly show immense strength. But, dissecting this complex relationship between operational excellence, that aggressive capital allocation strategy, and the undeniable member loyalty, and really figuring out which one holds the ultimate leverage, well, that remains essential for investors, for analysts, for anyone trying to understand how Costco can sustain this incredible level of success long term.